We shall begin this module by discussing about the importance of infrastructure. Infrastructure has pivotal role to play in economy's growth potential. Infrastructural development paves the way for enhancement of country's productivity, subsequently making firms more competitive and lifting region's economy. Infrastructure not only enhances the production, transportation and communication efficiency but also aids in providing economic incentives to participants of public and private sector. The infrastructural accessibility and quality region-wise aids in the shaping of domestic firms' investment decisions and further acts as crucial determinant of region's attractiveness to foreign investors. For most of the part, India has gave up the exemplary path led by manufacturing to development and in place of that has been focusing on its service sector. Though India has attained success on the front of information technology services and business processing exports, but its infrastructure, which is not sufficient, has crippled the manufacturing sector's growth. Acknowledgement has recently occurred on the part of Indian government that its growth levels have been restricted by low levels attained by infrastructure development. It has been estimated that the country's deficient infrastructure has constrained economic growth by the rate equivalent to 1.5 to 2% per year. India's central bank has proclaimed recently infrastructure bottlenecks are emerging as the single most important constraint on India's economy. The manufacturing sector of a country is lacking because of relative inefficiency and infrastructure's huge cost. Railways, roads, airports, ports and electricity. The lack of adequate infrastructure is constraining not only on foreign trade but domestic trade as well. The Indian government has decided to increase its expenditure on infrastructure from 3.6% of GDP in 2005 to 8% of GDP in 2008. The government estimated that roughly $500 billion will be required by the end of 2012 to sufficiently upgrade roads, ports, airports and power. After studying this module, you shall be able to know the role of infrastructure in economic development, identify the issues related to financing of infrastructure, know about the policies crucial for infrastructure development, know the 12th 5-year plan recommendations for infrastructure development. Let us now discuss the issues in financing infrastructure. The importance of infrastructure for sustained economic development is well recognized. Planning Commission in its midterm review of the 11th 5-year plan noted that India has been adversely impacted on an average by 1 to 2 percentage points due to infrastructure bottlenecks. Huge cost of transaction cost from inefficient and deficient infrastructure restricts the economy from reaching its potential of full growth, though there has been progress on other fronts. For a GDP growth rate of 9% and investment of rupees 41 lakh crores 2006-2007 prices in infrastructure sector is required over the 12th 5-year plan. The same when translated into nominal terms, assuming 5% inflation, works out to be rupees 65 lakh crores. In this context, some of the major challenges faced by the infrastructure sector are discussed as follows. First, speedy implementation of projects. Land acquisition and environmental clearances are the two main issues which matters infrastructure developers. These two issues have been prevalent since a long time and are the prime most reasons why infrastructure projects invariably get delayed. One of the way to remove this situation is that land acquisition should be carried forward by the government before the project bidding stage and project initiates post land acquisition. Since land ownership is in question, a national level congruent state center institution needs to be set up in collaboration between the state and central governments and be staffed with personnel of high integrity to oversee the task of land management. Lastly, allotment to the project developers by such mechanism as competitive bidding in shorter period of time. While in some states like Gujarat, solar parks development and wind site allocations have been done with an unusual alacrity. The same example needs to be followed across the nation as a whole. Additionally, scope, terms of reference and obligatory process of environmental clearance need to be standardized and suitable body or independent consulting companies should be fostered to help bidders and developers in obtaining such clearances at a faster pace. Environmental and land acquisition issues should be addressed proactively to balance the interest of all stakeholders. Second, coordination between government agencies. The actions and policies of different center and state government bodies and even central ministries need to be better coordinated. For this, a single window clearance system should be implemented with specific guidelines for time-bound approvals. Third, short tender process. A reduction in time lag between bid for a project and the commencement of construction will reduce the project cost and expedite implementation. The rise in material cost due to inflation would also be then controlled. Frequent changes in the important agreements such as the model concession agreement, request for proposal RFP, request for quotation RFQ, norms should be avoided as it makes the project implementation difficult and results in bidders spending a lot of time, effort and money in performing due diligence. Fourth, limited depth of the Indian debt markets for long-term funding requirement. India is heavily reliant on budgetary support and bank credit for funding its infrastructure needs. Infrastructure projects have a long payback period and require long-term financing in order to be sustainable and cost-effective. There is a need to improve depth and liquidity of the corporate bond market to provide additional source of funding for infrastructure companies. This will stimulate supply of much needed capital towards envisaged infrastructure spending. There is a need for further development of the Indian debt market because the funding gap will have to be filled up by permitting financial products necessary to be floated in the Indian markets in both fixed income and equity product offerings. Since financial leverage represents almost 70% of the requirements, there is an urgent need for infrastructure borrowings based fixed income products. This will not only increase the capital inflow for asset formation in the infrastructure space, but it shall also create a more equitable distribution of the sectoral risk. Next, we shall discuss the policies. In India, income tax incentives have been provided either to the infrastructure project itself or to the investors in such a project. Some infrastructure projects enjoy a tax holiday for a few years, but for long gestation projects, this may not mean much in present value terms. As these projects do not expect to make significant profits in the initial years, interest earned on certain infrastructure bonds has been exempted from income tax. Limited tax breaks have been given for equity investment in certain infrastructure companies. Central and state governments in India have underwritten the major sources of risk in some infrastructure projects through guarantees of various kinds. In many power projects, PPAs transfer all demand risk and input cost risk to the government. In some other projects, developers have, with varying degrees of success, been demanding guarantees from the government in respect of projected traffic and other demand parameters. In many emerging markets, including India, governments have used their directed credit systems to channel funds into infrastructure. Providing credit enhancement directly and transparently has the advantage of not weakening the financial system. Next, we shall discuss the recommendations for infrastructure development as per the 12th five-year plan. The projected investment requirement for infrastructure for the 12th five-year plan for 9% real GDP growth is Rs 65 lakh crores in nominal terms. Since India's domestic savings rate is very high and projected to grow, much of the infrastructure investment need can be financed domestically. Still, such high rates of infrastructure investment constitute over one-third of India's financial savings and would entail as much as 21% of the incremental financial savings being directed to infrastructure. Yet, it is not just the adequacy of domestic financial savings that matters. These savings have to be intermediated into infrastructure to achieve these targets. Let us now move on to discuss the debt funding. Until the mid-2000s, there was no major demand from the financial system to fund infrastructure investment as it was fairly low, around 3 to 5% of GDP, and financed largely by budgetary allocations and the internal resources of public sector enterprises engaged in infrastructure. In the 11th five-year plan, however, infrastructure spending picked up substantially, with an important role played by the private sector and greater recourse to the financial system. Most of the debt financing came from banks, non-bank finance companies, NBFCs, and external commercial borrowing (ECB), followed by insurance companies. First, we will discuss about commercial banks. The financial system was able to respond to the rapidly rising demand for credit by infrastructure companies largely because banks stepped up lending by unwinding their excess investments in government securities maintained as SLR. SLR investment as a share of deposit came down from 47.3% in financial year 2005 to 29% in 2011 as the credit deposit ratio increased. Credit to infrastructure grew at a faster pace than total credit, and the share of infrastructure in gross bank credit rose from 6% in March 2007 to 11% in March 2011 and to almost 15% as a share of non-food credit. As a result, it is estimated that banks were able to provide about half the debt finance needs of infrastructure investment. This rapid growth in bank credit to infrastructure has resulted in a greater concentration of risk in bank. Due to ALM mismatch and reaching exposure ceilings, the banks have prudential exposure caps for infrastructure sector lending as a whole as well as for individual sectors. As per the information available, most of the banks have almost reached the prudential caps for power sector. Other sectors like roads may not be far behind. Going forward, credit growth will be mainly determined by retained earnings and increase in banks' capital. However, as most of the infrastructure lending is by public sector banks (PSB), raising capital can only take place if the government dilutes its shareholding or infuses capital into the PSBs. We assume that infrastructure credit growth is determined by only retained earnings. Assume that retained earnings grow at 20% per annum for PSBs and at 25% per annum for private banks, and infrastructure credit rises to 15% of total credit, then the net incremental bank credit to infrastructure over the 12th plan will be about Rs 7.5 lakh crores. As pointed out earlier, power and road sector will face significant constraints as our exposure is already high. However, it may be worthwhile to point out that the funding gap will not be felt universally. Some of the smaller sectors will be able to get adequate funding subject to availability of commercially viable bankable projects, but the funding gap will be much larger for power, roads, etc. Next, the infrastructure non-banking finance companies (NBFCs). Non-bank finance companies (NBFCs) also increased their lending sharply as the credit demand for power, telecoms and roads expanded. The major infrastructure finance companies considered are PFC, REC, IDFC, IIFCL, L&T Infra and IFCI. The outstanding credit from IFCs to infrastructure sector has increased from rupees 1,10,549 crores in financial year 2008 to rupees 1,81,595 crores in financial year 2010 at a CAGR of nearly 28%. The PFC and REC, which together constitute nearly 80% of the lending by IFC, have had their outstanding credit growth at nearly 27% per annum. Going forward, the high historical growth rates observed in the past may not be feasible as NBFCs will need to take up further capital raising exercise to be able to lend significant amounts. Hence, for the purpose of estimation, the growth rate for financial year 2011-2017 has been assumed at nearly 20% per annum, which is at the same levels as commercial banks. The gross credit available from the IFC towards infrastructure sector during financial year 2013-2017 is likely to be nearly rupees 4 lakh crores. However, it will be pertinent to point out that the IFCs like PFC and REC will fund only power sector projects. Let us now discuss about insurance companies. Life insurance companies are required to invest 15% of their life fund in infrastructure and housing. Although the asset under management AUM of life insurance in the life fund increased at a CAGR of 16.31% per annum, the share of infrastructure investments during the same period increased only marginally from rupees 69,837 crores to rupees 72,439 crores at a CAGR of nearly 1.25% per annum. As a result, the share of infrastructure investments in the life fund has come down to 10% in financial year 2011 vis-a-vis 15% in financial year 2007. For non-life insurance, the AUM increased at a rate of 9.62% per annum from rupees 50,383 crores in financial year 2007 to rupees 66,372 in financial year 2010, whereas the share of infrastructure investments increased continually from 12% in financial year 2007 to 16% in financial year 2010. Insurance penetration is estimated to continue to rise, with the insurance premium growing from the current approximate 4% of GDP to 6.4% of GDP by the end of the 12th plan. Investment in infrastructure by the insurance sector has been projected based on the past few years' average investment by insurance companies, about 63% of premium. Besides the life fund, life insurance companies have the pension and annuity fund and unit-linked fund income after deducting commissions and expenses, and the infrastructure investment as a share of the total insurance investment flows of 6.2%. While there is much greater scope for channelizing insurance funds for infrastructure which needs long-term funding, there are various prudential and regulatory constraints in the sector precluding this. Thus, going forward, combined funds of rupees 1,50,766 crores may be available from insurance towards the infrastructure investments during financial year 2013-2017. If insurance penetration grows rapidly, but the pattern of investment in infrastructure of the past few years continues. Next, we shall discuss about the overseas market. ECB Infrastructure Companies also tapped external credit markets. The share of infrastructure investments in overall ECB borrowing has gradually coming down. The estimates of the external borrowings during 12th 5-year plan are based on the 5-year averages, financial year 2007-2011, of the actual external borrowings. Next is equity and FDI. The equity FDI during the first 3 years of 11th 5-year plan were approximately 14% of the total investments made towards the infrastructure building, whereas the overall debt contribution was 41%, implying a debt equity ratio of 2.93:1. Assuming that the proposed infrastructure spending gets funded in the same ratio, the equity FDI available is estimated at rupees 4,45,414 crores. However, it would be pertinent to mention that equity funding will be a key constraint going forward, possibly even bigger than debt financing. A large part of equity investments relies on foreign investments, with domestic investment institutions not coming in majorly at primary level for taking equity in infrastructure projects. Regulatory changes which will make projects commercially attractive are needed to draw adequate equity capital to infrastructure sectors. Also, other changes like amendment in pension PF regulations to allow investments in equity markets will be critical. Further, we discuss about total equity and debt funds available. Based on the above analysis, the total funds available from different sources apart from budgetary support is as shown in table. Now, in the table, as you can see, the total equity and debt funds available. The sources of fund have been given: debt, then commercial banks. The funds available are 7,43,511 crores, IFC 3,84,477 crores, ECBs 54,957, insurance funds 1,50,760 crores, total debt funds 13,33,712 crores, total debt funds 13,33,712 crores, equity and FDI 4,55,414 crores, total funds equal to 17,89,126. Let us now summarize what we have learned in this module. Infrastructure is a key determinant of the growth potential of an economy. Developing infrastructure enhances a country's productivity, consequently making firms more competitive and boosting a region's economy. Issues in financing infrastructure: speedy implementation of projects, coordination between government agencies, short tender process, and limited depth of the Indian debt markets for long-term funding requirement. In India, income tax incentives have been provided either to the infrastructure project itself or to the investors in such a project. In many emerging markets, including India, governments have used their directed credit systems to channel funds into infrastructure. Providing credit enhancement directly and transparently has the advantage of not weakening the financial system.